Hi everyone, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and this is your third quarter 2023 market commentary. The global stock market, both the US and outside the US, took a bit of a breather here in the third quarter and pulled back about 3% in the US and about 4% overseas. Global real estate had a disappointing quarter, being down about 6.5%. And the bond market struggled in the third quarter as well, being down a little more than 3%. The Federal Reserve did raise interest rates by 0.25% in July, but kept interest rates the same later in their meeting in September. And I think there were a lot of moving parts in the third quarter that ended up resulting in stocks and bonds, taking a bit of a breather and a slight downward movement for the quarter. Interestingly enough, the quarter started out very nicely, with July being a fantastic month as the debt ceiling issue was resolved earlier than that. But August was a slight downturn, and then September was effectively the worst month of the year as stocks really retreated strongly in September. When you look at all the information of what has happened this year economically, with the jobs reports, with inflation, and you take all of that and you kind of zoom out a little bit, if you're able to take a slightly longer term view, let's say, for instance, the last 12 months, so the last 1 year, the stock market and bond market actually have had a pretty good 12-month time frame, a really good 12-month time frame, an above average 12-month time frame for the stock market specifically. This handy chart here shows in the purple that the total world stock market is up about 22% from last October, which is a very nice return when you look at that time frame. Obviously, any investor, nobody would be complaining about that type of return over the last 12 months. The bond market is even positive over that 12-month time frame, even though so far this year the bond market is negative. The returns from last November and December were enough to continue to make the bond market positive over that 12-month time frame. I hear from a lot of investors and clients that say, I see the numbers of how the portfolio has done over the last 12 months. It just doesn't feel like that has happened. And that's because there's been, number one, a lot of market pundits with negative commentary on what might happen in the stock market or what they think might happen in the stock and bond markets. Whereas the day-to-day, week-to-week, month-to-month economic news that actually has been really good over that 12-month period, just doesn't grab the headlines in the same, type of way. If you go back to what people were saying last September, last October, it was a foregone conclusion that the U.S. was going to go into a recession. Everybody was predicting that. It was a question of how quickly it would come, and if maybe we were already there. But, as people say, how is it possible that the stock market's recovered so much since effectively what was the bottom last fall? Why would the stock market go up so much over that time frame? And the bottom line is that, the data that came in, both corporate earnings, inflation numbers, GDP numbers, job report numbers, all of which have held up better than expected. And when that happens, the stock market reflects that information as it all comes in, as it should. The long Wall Street phrase, the classic Wall Street phrase, is that in the short term, the stock market is a voting machine. Everybody gets to decide and take a guess as to what, might be the right price. But in the long run, the stock market is a weighing machine, in that we will all find out the truth. We will all find out exactly how much money did Microsoft earn in the third quarter. We will find that out. That type of how much did the U.S. economy grow in the third quarter? How much How many jobs were filled in the third quarter? What's the unemployment rate for the third quarter? All that information will come to light. In the short term, everybody gets to guess on what those numbers will be. And then in the long term, we get the actual information. And if the information is better, the facts ends up being better than what the guess was, then of course stock prices and bond prices will reflect that. And that's exactly what's happened. So essentially, last year's downturn was maybe too pessimistic, too negative, and this year, the last 12-month upswing has reflected that those original guesses from 2022 on what might happen to the economy were too pessimistic. That's somewhat the bottom line. If you want to boil it down to one simple sentence as to why the stock market has done well over the last 12 months, it's because the previous 9 months were overly pessimistic as interest rates increased throughout the beginning part of spring, starting in spring of 2022, and throughout the summer and fall of 2022. And we can even put some numbers on that. If we go back to October of 2022, the inflation rate was 7.7%. August 2023, inflation clocked in at 3.7, which is obviously a major decrease. And the whole point of why the Federal Reserve was raising interest rates so fast was to try and combat that inflation, which appears to have worked so far. They're not done in terms of getting to their goal of 2%, but they're a heck of a lot closer than what they were October of 2022. The second quarter 2023 GDP numbers came in at 2.1%. That is very clear. Those are not recession numbers. Recession numbers would be negative. That is not negative. And the predictions for the third quarter, predictions, right? Because we don't have that information yet. But the predictions for the third quarter are GDP clocking in at 5%, which would be unbelievable. That is nowhere near a recession. That's the opposite. That's pretty serious economic growth. Unemployment-wise, jobs-wise, the September reports showed 336,000 jobs added. That's growth numbers. There's no recession there. And the unemployment rate remaining at 3.8%, which is right in line with the Federal Reserve's long-term goal of having inflation be around 4%. So they're in great shape on that front. And so, when you think about all those pieces of information, of course, the stock market has reflected that, as it turns out, things look a little bit better economically than what the predictions were this time last year. So obviously that is a good thing. Hopefully that going forward, the stock market continues to recover. It has not fully recovered to its previous peak back in the first quarter of 2022, but it certainly has made up a lot of ground over the last 12 months. One other thing that I always like to show here, just to get an even longer term view, sometimes in a year like this where there's a big divergence between what has happened in U.S. stocks, specifically big U.S. stocks, even more narrowly, really this entire stock market upward swing in the U.S. anyways, has been mostly as a result of about the top 10 largest companies doing really, really well. So, the Apples, the Nvidias, the Microsofts of the world having a great year. Now, keep in mind they had an absolutely atrocious 2022. So some of this is just simply them bouncing back from some of the big losses that they had last year. But sometimes people will sort of say, well, geez, why don't we have a lot more in that one category and not own any of these other categories, or own quite a bit less of these other categories when a big divergence like that happens? And of course, the answer is because no one category always wins. No one category wins forever, or even for that long of a period of time. Yes, it's certainly possible that one category can have a nice stretch. But the fact of the matter is, nobody in the short term knows what's going to do best. If they did, investing would be easy. Not only would it be easy, it would be in their best interest not to tell anyone what they know. Otherwise, they might spoil the effect of the advanced knowledge they have, which no one has had. There's no one in history that's been reliable at predicting the short term in the stock market. The world's most famous investor, Warren Buffett, says that you should not invest based on short-term predictions at all, and he claims all the time that he has no idea what's going to happen in the short term, and he doesn't need to know what's going to happen in the short term to be a successful investor. So when we show this chart from JP Morgan, this is effectively the last 15 years of asset class returns ranked by calendar year and which categories did the best in each calendar year. And so you've got 2008 all the way through 2022. And then all the way on the right, you have year to date for 2023. So you can see that U.S. large stocks have really led the way compared to all the other categories, which have had, either negative returns or more muted positive returns. But then all the way on the left side of this chart, you can see the annualized return over that 15-year period that effectively shows all the different asset class returns. But what I really want to highlight here is that a diverse portfolio, which is the white box titled Asset ALLOC, which is short for allocation, effectively says, well, what would a diversified portfolio have done over each of these calendar years and then cumulatively over this 15-year period that we're looking at? How would have that performed? And you can see over that time frame that it's in the top half of performance for the total time frame, and you did not have to risk either being all right or all wrong at any given moment. If you diversified, you would find yourself in the middle to slightly above average middle of how everything is doing, and you don't have to risk that you would be in the wrong place at the wrong time. And that's extremely important when you're investing because, again, in the short term, nobody knows what's going to do best. And particularly if you're someone who is retired or living off of your portfolio, you can't afford to get that wrong when you're spending from the portfolio. You have to have a mix of investments that act differently from each other, so you can weather the storm when some things do poorly, and you can participate in the gains when other things do well. And because you don't know in the short term, and no one else does either, what's going to do best, we have to protect ourselves by owning different things. And that will enable us to be able to provide cash flow to pay for your living expenses in retirement without having to sell something at a really, really bad time. But also ensure that you participate in whatever does best so you can have the portfolio keep up with inflation and last as long as you need it to. And so they call this kind of like a quilt chart because that's what it looks like. You can kind of see all the different colors change, when things are doing well and when they're doing poorly. Very good example is, just literally the last 24 months. I mean, year to date, U.S. large cap stocks are doing the best. And in 2022, they were one of the worst categories. So you can kind of see, how things ebb and flow in the investment markets, and that in the short term, there's no advantage to be gained by trying to guess which one might do best and how long that might happen. So this is we think a very valuable type of visual that helps people really understand that diversification is your friend and one of the best things that you can implement when you're trying to build a portfolio, specifically if you are intending to live off of that portfolio and supplement your income in retirement. So with that is the recap of the third quarter 2023. One other thing that we do want to mention as well, we mentioned this in the quarterly letter too, but if you feel so inclined, please leave us a review on Google for Level Financial Advisors and your experience in working with us. We'd love to hear your feedback and always appreciate that. And with that, until next quarter, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and we'll catch you on the next quarter. Thank you.